Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Good. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks for tuning in each and every week. Had a little bump in the road on our recording date this week, but we are up live and the show is uninterrupted. So if you want to see us, hear us, tune into the great radio stations that we're on. We're on 5 of them in 3 different states, from Albuquerque all the way up to Las Vegas. Certainly in Inland Empire in Southern California, as well as up in Central California, up in the Tahoe region. YouTube, Jeff Barton, the Mortgage Voice. You can see it. We're on the Big 8 podcasts. I think, Daryl, you got a list of those there?
I sure do. It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and, of course, the infamous YouTube.
Thank you very much. Yes, okay. So let's get into a little bit of what's going on personally, professionally, in the industry, and, of course, what's going on with rates. All of these things affect us all every day. We've had a number of different indications that rates will probably be the same for a long time. Usually, as everyone knows, it's ruled by the bond market. The bond market itself sells debt, U.S. debt, and that 10-year note is how we really gauge what's going to happen in the rates going up or down. And we're so spoiled. I read an article today that said, because of the fact that these low rates have been around for so long, it's really hurting the economy. What they're referring to, of course, is that we can't do a dramatic drop in mortgage rates if we wanted to, or we can't do a major anything having to do with rates or the bond market, because we've had below 4% for a year and a half. We've had below 5% for 2 to 3 years. If you've listened to the show, you know when I got my first mortgage, it wasn't all that long ago, really. Well, maybe it was, but it was 8 3/4%. Happy to get it. $100,000 I borrowed against a $400,000 loan, and subsequent to that, I got a 5.125 15-year, and that was after about 5 years into the first note. So where can we go in terms of how we're going to gauge what happens in the market, and the market actually go lower? And is this experience that we've all had really hurting us when it comes to expectations in the marketplace, both on the real estate side, the real estate buy side, selling side? Heck, the seller gets what they get. And if they put too high and they got to sell low now and they got to move, that's just what it is, unless they want to be landlords and rent. When you're a buyer out there and you're trying to wedge yourself in, you have become so accustomed to these low rates, it's very unrealistic for you to accept anything which would make it be a point higher. I mean, can you see a time where America will be paying 4.5%, 5% for a 30-year fixed rate loan? And what will happen to the 30-year fixed rate loan, by the way? We're talking about the GSEs, Fannie Mae, Freddie Mac, coming out of conservatorship. What does that actually mean? It means the government control, the FHFA, direct control, i.e. their stake in it, will be, bought out, and the GSEs will be allowed on their own. And there's been talk to try to make these entities 100% private, meaning that there is no government backing. Now that's going to kill the bond market, right? Obviously, the mortgage-backed securities, the reason that they sell where they sell is because the government backs them. And Ginnie Mae, Fannie Mae, and Freddie Mac backs these loans. If that goes away, you will see rates really rise. And there is talk that is going to happen. And it's always been the wish to make mortgage lending private again. And the fact that that is still in the works, even as a result of the pandemic, and before that we had the mortgage mortgage pandemic, I guess we could call it, really affected the worldwide markets for lending money. And that part of it, part of the equation, which really is only 12 years ago, is now paled in comparison to what we're going through now. But the idea that we're going to have a steady, low interest rate for, what did the Fed say? What did Jerome Powell said through 2022 or 2023? Do you remember, Carol? Have any idea on that?
2023 at this point, yeah.
Yeah, I think that's right. I think that the 2023 mark, so we're in 2020, and so that's going to give you at least 2, if not 3 years more of extremely low interest rates. How does this skew the housing market? I sold a property where I live 2 days ago, and they got the loan approved, and they're ready to close. Now, this is $1 million property. They're going to be paying 3.5% interest rate on a $800,000 loan. It's unbelievable. How can this last? And does this adversely affect what a property is worth or what a seller can expect to get? And are those expectations able to be met when we return to a more normal market? Because that, if I read the tea leaves right, and the GSEs get released, and we're looking at a private market in terms of the mortgages, let's say mortgage interest rates were 6% right now, which are historically very low. 6% is a low interest rate for a 30-year fixed rate loan. If we can get a 30-year fixed rate loan when it becomes 6%, what is the real estate value if loans are that expensive? Does it matter? Well, it should matter, because what would happen if we raised interest rates or they went up to 6%? You would find the pool of buyers. What do they say? Every time you raise it by 1/8 of a point, you lose 100,000 buyers. So if we're raising it 3 points, that's, yeah, it means that the pool of borrowers that you have currently available in the marketplace are going to dissipate based on the estimates of how long it's going to take us to get out of this employment issue we're in. 11, 12 million people still out of work, plus all the layoffs coming. Disney's laying off, the airlines are laying off, all of the hotels that have already laid off are laying off more. What's going to happen to get those people back to work again? If they're only adding, what was last month's unemployment? They added, I think it was 400,000 jobs, 600,000. It was way less than what they wanted. We wanted to see employment be 1.5 million people, maybe 2 million. Not even close, 400,000, 600,000 in that range. Well, if you're looking at 11 million people, how long is it going to take you to get employment back to where we would consider it full employment? Well, let's say 400,000, let's call it 500,000 people back to work a month. That's 5 million a year. That's, going to take 2.5 years if in fact we continue that job growth. We've seen it winding down, not winding up. So we may see even less next month, maybe 300,000, 200,000 in December. These are numbers that are not great. And if we do have a rise in interest rates, what's going to happen to the overall real estate market? These are forward-thinking projections. And I think about that because we're in a forward-thinking time right now, right? We're looking at, when are we going to get a virus vaccine? Who's going to win the election? When are we going to be able to get back to work? These are all futurized things. And as I deal with my own issues, as I was talking to Daryl off air, my own household, I've got kids that age who need jobs. One of them's not working right now. It's really affecting the stability of both his mental state as well as his wanting to get on with his life. All of these things are futurized. We can't really look at the market the way it is today and say, this is what it's going to be for sure. This is how we're going to get out of this. It's a very unsure and I don't have the predictive crystal ball, I guess what they'd say. And I wish I did, but I don't. And so prognostications aside, where we are right now is the real estate market is pretty good. It's hot, going up. A lot of buyers out there. Real estate interest rates on mortgages are really low. So if you're just looking at today and you've got the wherewithal to be able to put a down payment in, today's your day. Get out there, look at the market, see what you can afford, and put a down payment on it. That'd be the way I am. Are we on time, Daryl?
We got about 30 seconds.
Okay, excellent. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Really appreciate you listening to the show each and every week. We're getting a lot of great feedback off our LinkedIn and our YouTube spots, which we do daily, 3 to 5 minutes to let you know what's going on. I'm Jeff Barton, and we'll be right back.
Right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to the Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening. Thanks for tuning in each and every week. It can be seen on YouTube, Jeff Barton, the Mortgage Voice, heard on Big 8 Podcast, and there's 8 of them. Daryl, you have that list for me?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and YouTube.
Excellent. Thank you very much. Go to YouTube, sign up, sign in, say you like it. Why? It helps me get the message to other people. There's a lot of information. There's a lot of things that you need to know if you're going to try to get a mortgage or if you want to learn more about real estate. The more you know, the better you're prepared for whatever's going to come up in a deal. And believe me, many things can come up in a deal. You can also hear the show. We're on 5 radio stations in 3 different states, Albuquerque, New Mexico, all the way up to Las Vegas, Nevada. We're in the Inland Empire in Southern California, as well as up in the Lake Tahoe area at K Tahoe. Again, thanks very much for listening. With us today is Dave Doyle. He's been a realtor for Bridgeport Real Estate for a number of years. We've had him on the show talking about market conditions and what's going on. Wanted him to come in today and give us a little bit of education, or at least briefing on what is happening in his area. Dave, how are you?
I'm doing good today, Jeff. Thank you for asking.
Okay, excellent. All right, so anxiety in the marketplace, anxiety in home buying, COVID, let's see, interest rates being low, 30-day escrows. So what's going on with you, and how are you handling it?
Well, besides trying not to pull my hair out, it's actually been better than most might think. You know, with all the new safeguards on trying to show a property with all the COVID restrictions, that in itself has been a challenge. But the market is so strong. Interest rates are so low. Yep. We have properties, as long as they're priced correctly, they're going. You know, I think the biggest challenge today is, you know, getting deals to close, because there's so many different variables and anxiety in the marketplace that people get cold feet when, let's face it, they're spending less per month for that same home they wanted 2 years ago, you know? And it's just kind of a no-brainer. But there's a lot of anxiety in the market today.
Let's say you're having an interview to try to list a person's house. You want to go talk to a seller. How do you get them to realize that pricing is the number one factor that's selling the house quickly? Even if you price it a little low, you probably get multiples. How do you talk to them about that?
Wow, you know, it really depends on their state of mind.
Right.
Because everybody thinks they're driving a Rolls Royce when they're not. You know, and if you're not pricing something correctly, you know in the first 10 days it's on market, if not sooner. You really do. Because if you're high priced, you're stagnant. You know, people don't even want to come look because they're like, oh, they're not even going to consider. You know, if you're 15, 20,000 overpriced, you're just you're losing the mark. When the crazy part is, I got a house that's worth 8.25. And if I try and put it at 829, I'm probably going to sit on market with no offers. Or if I throw it in at 799 or 805, I'm probably going to get multiples and bring it back up to the 820, 825 mark within the first couple of weeks. So it's important when you're doing a listing presentation for somebody to get them to trust and have confidence in you that you know that marketplace. You know, the hard part is where you know a house is worth $825 and they want $850. That's where it gets a little crazy. And they're like, well, the house down the street sold for that. I'm like, the house down the street had new kitchen, new bathroom, new floors. They probably spent $80,000 doing all that work.
Yeah, that's right.
The house is original. And getting people to digest that, like I say, they think they're driving a Rolls Royce, but they're not.
You know, you speak to something that just happened to me. We had a unit that sold and passed all contingencies, and it was priced. There were 3 units in the particular complex, and one was $200,000 above what this one was priced at. Another one was $300,000, and of course, those properties are sitting. This property sold in, less than 30 days, and it'll close. So you can be fishing forever for the best price because, as you say, you think you have the best property in the market, and how does this compare to the one across the street or the one down the street or a sale that happened 2 years ago? Getting people to trust you is the key. My particular seller trusted me when we priced the property, and it sold quickly. Now, that trust factor is good because I knew the guy for 10 years. Getting people who don't know you, maybe of a different mindset, is not easy. And quite often what happens is they end up blaming you if it either doesn't sell quick or there are problems during escrow.
That happens. That happens to the simple point of whenever you have, I kind of look at it like this, okay? If I'm a passenger on an airplane, I'm not the pilot.
Right.
If I walk into a doctor's office and I think I know more than my doctor, I'm probably not going to get his best service. So we as professional real estate brokers and agents out there, we bring all of our knowledge to the table to help our clients get the best deal, whether they're looking for a property or trying to sell a property.
Right.
And we have to develop that trust and rapport with them. Now, if I'm listing their house, I need to spend the time to develop that trust with them. I can show them track records for many properties that I've sold, where they've sold at in relation to listing price, close price, and all that stuff, right? Almost anybody can print all that stuff up. Bottom line is, you're with somebody you can trust when they're giving you personal attention. When they're the ones out there, when they're not just signing up everything and then they're, deal with my assistant on this, deal with them on that. Because at the end of the day, as a listing agent, I spend quite a bit of money between marketing, signing, just all the different variables that go along with marketing a property.
Yep.
Okay? I spend quite a bit. It's in my best interest to recoup my costs. I don't want to recoup that cost if I sell the property, but it's in my best interest to make my client happy and satisfied and get them what's there on their property because I want a good review, because I want a good referral, because I want to do for them just like I would want to do for myself. And here's like a little funny one that we ran across. We see someone selling a property and it goes on market on Tuesday and it's in escrow on Wednesday. And everyone thinks it's great, it's awesome, it's wonderful. Anybody who's been in the business knows, well, wait a minute. No. They priced it correct to get offers in, then they jumped at the first offer that came in when that thing should have been taking the time to brought up to its fair amount. They left a bunch of money on the table by doing that.
Right.
And if you're ever wondering if that's true, just look at any property a real estate agent or broker owns that they sell themselves and look at the days on market.
Right.
It'll always be more than 12, 10 or 14 days because they know they take the time to negotiate it, verify everything, make sure it's a strong buyer, not someone that's going to fizzle out in a few weeks, and get the best price. I'm always willing to take the time to do that to get the best price for my client.
Well, as you said, it's in your best interest to get the best price.
It's in my best interest to get the best price, not just to recoup my losses I've spent on marketing the property, but I want a good referral. I want a good rating. I want a good review. I want a happy client because every happy client I have gets me 3 more.
I agree 100%. Yep.
You know,
I think that's a great attitude.
Every injury client I ever have, which thank God I haven't had, will probably cost me 3 clients and a whole bunch of money in marketing to get more.
Right. Hey, Dave, we're up against the clock here. You want to shout out your phone number for people who need a great Southern California real estate agent?
Phone number 661-373-6577. Again, that is 661-373-6577. David Doyle, give me a call. I will not disappoint.
Thanks, Dave. Thanks very much. I really appreciate you coming on the show again.
You're welcome. Thank you.
You're welcome. Great. That's Dave Doyle from Bridgeport Real Estate. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Thanks for each and every week. We get a lot of feedback on the show about the specifics of what we do, and we greatly appreciate it. If you want to hear us all the time, you can go to any number of these podcasts. Jeff Barton, the Mortgage Voice. There's 8 of them. They call them the Big 8. You can go to YouTube. Jeff Barton, the Mortgage Voice is on YouTube. And you can go to all the archives. We have 5 radio stations, 3 different states. And again, thank you very much. Now, if you go to any of these things, click on that you like it, join up, to be alerted when we have our next show. Why? Because the more you do that, the more we get our information out to people who need it. And believe me, right now, there is such anxiety in the marketplace for many reasons that are beyond the control of an individual borrower. They need the information in order to be assured, reassured, or have questions that are likely to come up during the process. If you're forewarned, you're forearmed, as they always say. Today, once again, I bring a terrific guy who's been on the show several times, many times this year during COVID, especially, is Josh Thompson from Malibu Funding. Josh, how are you?
I'm great, Jeff. How are you?
I'm fine, thank you. I wanted to bring you on today because there's, as I was saying, anxiety in many people who are in the business because of the volume of activity. It just creates a lot more work. And when there's fatigue that sets in after months of it and months of it, errors can be made. I wonder if you could speak to the fact that maybe some people out there have expectations on professionals that are just not able to be met, either for those reasons I just mentioned, or the fact that, those type of loans don't exist anymore.
Yeah. Well, yeah, I mean, I can definitely attest to the fatigue aspect. I mean,
Right.
Just with rates being where they are, everyone in the world is just, you're bombarded with calls all day. And then I think the other element of working from home for most people,
Right.
It's kind of like you never stop. It's like you're sleeping at work. So yeah, I can attest to that. And I think just with the higher volume, there's a lot of lenders that are adding new overlays of things that, it's just a lot to kind of keep up with. Things that were okay 6 months ago are not allowed anymore. So we're kind of all just adjusting on a day-to-day basis.
Right. And I think expectations of people and clients, whether you're dealing in purchase or refi, are sometimes, it's too much, right? You can't meet the expectations. Or I know that recently we had an issue with a borrower who expected a certain thing, and because the lender that we were dealing with didn't deal with what needed to happen at the end, at the beginning, all of the expectations of the borrower built on the trust between the loan officer and the client, the person who's complaining, is for naught. And so what happens is they become agitated, and there's a lot of anger and a lot of finger pointing, and people get upset. How do you deal with that? How do you avoid that? Is there a way to avoid that, especially, in our business where it seems that disclosure of what's needed by the lender, there is no clear distinction between you're the lender. No, we're the broker. The lender is over there. Speak to that if you would, please.
Oh yeah. I mean, you can always try to safeguard against, someone, client feeling, mishandled or what have you by doing everything that you can. Because, like you said, on the broker side, the broker is kind of, operating in the best interest of the client at all times. So sometimes the lender is throwing things at the broker that are not necessarily things that even the broker agrees with, Right. But one thing I would say is, for the client, from the consumer standpoint, I think a lot of consumers, like you said, are unable to kind of identify the different hats of, and whose responsibility is what. But, even in this situation that we were talking about, I think that it's better for, a lot of real estate agents who need to put in more of a safeguard and kind of structure contracts to reflect what's actually going on in the market today with lending, because a lot of agents are still writing up 30-day contracts with,
Right.
17-day contingency periods and things like that. And that's just not how the market is going, So I
Agreed.
think a lot of it relies heavily on managing expectations with clients up front. But I would say, even more so than the loan officer and the broker, I think that agents need to do a much better job of setting those expectations and understanding, and being realistic about what can and cannot be done at this time,
Well, from a lender standpoint, you're right on. From a realtor standpoint, you're competing. So the less you have as contingency of your offer, more chance you're going to have it accepted. So they're in a tough position as well, because not only does the client want to close quickly or get the property to even try to close, but they're competing against 3, 4, sometimes many more offers, which some are, obviously have less contingency. They don't have a 40-day escrow. They don't have need to remove contingencies actively. It's a passive removal. And some states are passive, some states are active. Anybody who's going to build into their contract more roadblocks for the seller is going to look at the one that's easier. So this is a system issue, and also not an easy issue when it comes down to, okay, if something doesn't happen the way we said it was going to happen, who's to blame? And always that happens when they point at people like the lender. Always. The loan officer's at fault, the lender's at fault, and it comes because of the fact that we're busy, because of the fact that we're fatigued, because of the fact that all these other factors that you mentioned happening makes it extremely difficult, and therefore adds stress to the entire process, which I think at this point in the game, we may only be halfway through, maybe only a quarter of the way through this COVID thing. So it's good. It's here to stay. I don't know how we deal with it.
Yeah, I mean, you're hitting the nail right on the head, and I'm just hoping, and this may be an unrealistic hope, that everyone, I mean, but still, even to this day, with everything that's going on and volume that's happening, there's still people in the real estate business and consumers that don't understand that fact. So, instead of, I think everyone's comparing experience now, with buying a home or refinancing with, a time when they did it 2 years ago. And it's just not, I think consumers need to really understand the situation and understand that it's not that same time, So I think everyone just has to make adjustments, but managing expectations, I keep saying that's the echo of this conversation is I think key to making everything run more smoothly.
Well, would you shout out your phone number for people? I know that listening to you talk, your expertise, and the way you manage, as you say, the expectations as well as perform, that'd be great information for people to have how to get a hold of you.
Oh, yeah. Hi, my name is Joshua Thompson. My number is 323-945-5694.
Okay, and you work primarily in Southern California, but you do projects all over the place, right?
Oh, yeah, definitely do.
Yeah, and you're in development, and you've been on the show talking about that previously, and again, I appreciate it. I wanted you on to talk about the difficulties in so that maybe this conversation we're having lets people know, hey, this is a different situation. I know that consumers have their own worries, but if you're trying to do something like buy a house in this particular market, these are the issues that we deal with, and that, as you say, managing of the expectations is about the most important thing you can do. Again, forget that and demand that you get it done today. I know how it works. But thanks for coming on this show, Josh. I really appreciate it.
All right. Thank you, Jeff.
Okay, man. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening and tuning in each and every week. We are on the Big 8 podcasts. And Darry, you got a list of those podcasts for us?
I sure do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, and YouTube.
Okay, speaking of YouTube, if you want to see the show, we shoot this for both YouTube as well as a couple of radio stations, and we're on 5 and 3 states. They carry video feeds as well. Go to YouTube, Jeff Barton, The Mortgage Voice. When you get there, click on that you like it. Join what we're trying to do here, which is educate the public about what's going on in the mortgage market. There's a lot going on all the time, even if rates are stagnant. What sets up today for tomorrow's rate is really important, whether it's the bond market, whether it's international events, whether it's just a local election. There's a lot of things that can really affect how you get a mortgage and what it's going to cost you. Today, I bring to the show Darren Woodworth, who has been on the show many times talking about what's going on up in his area. And I know, Darren, first of all, how are you?
Oh, I'm great. Blessed, overpaid.
Thanks, buddy. And you've been experiencing fires. One of the reasons I brought you on, because the conditions during something like this make loans and real estate different and difficult. First of all, how is everything up there? How are you? How is the property around where you are? How far away from fires are you? What's the smoke like? All that kind of stuff.
I'm actually in Vallejo, about a mile from Six Flags. So I'm quite a ways away from fires right now, but it's been smoky. But it's definitely nice today. It's been a little foggy, so smoke has been gone. So weather has changed. It's in the 70s now, so looking good.
Okay, that's good. When you're trying to get a loan for somebody, let's just talk loans for a second, and the lender is asking about what I did, the fires, and certain counties have redlined or they've been in danger zones. How do you advise the borrower about that when they're looking to you for some guidance as to how they're going to get their loan funded if they're in one of these areas?
Well, it all depends on where they're at. Just recently closed a deal where the COVID was the biggest thing, and they said 45-day closes, yeah, and the deal closed in 23 days. So there's a lot of misinformation out there. So we do our due diligence on the fires. It's last year they did a bill for 800,000 homes that delayed the canceling of insurance because of fire zones, and
right.
That's coming up. I think next month it's expiring. So we're still dealing with that. So we don't know if there's going to be an extension on that, because insurance companies like to drop, when you're in a fire zone or a flood zone. So we'll see how that goes. I give the best advice is if you need the money and you need the cash, we move forward.
Right. And the anxiety that kind of thing, most people don't even realize that they're either in a fire zone or COVID might affect it, or like you just said, fire insurance may be canceled. They don't know any of this until they get into the deal, right?
Correct. Until you start pulling stuff.
Right. And so solving the problems, solving the issues as they come up, that can create a lot of anxiety for you as the loan officer or real estate agent, as well as the customer. I imagine that can make for some pretty heated conversations.
Oh, absolutely. They're
Right.
looking for you for guidance. So the fear factor it's always there, but as long as we're informed on what our lenders are doing, it keeps us at ease so that we could, pass that on to our clients. 23-day close
That's
in
great.
the middle of COVID, that was even with July 4th being in a holiday, and we still closed it in 23 days. That was quite amazing.
Yeah, I agree with that. And what are the lenders telling you in regards to loans right now?
Pushing through. I just
Well,
submitted one this morning that's in line for review, so they don't seem to be slowing down.
now, difference between large lenders and maybe some niche or boutique lenders. Do you see a difference in the times, in terms of the turnaround times, or when you submit a condition on a loan after approval, does it take longer than normal with a big bank or a smaller lender or niche lender? How are they? I mean, what would you recommend to a client who came to you and said, "Okay, I need to close fast"? Where would you take them?
Conventional's pretty. I did that conventional in 23 days. So there are niche loans out there that are, undocumented. Use pay stubs and bank statements, and you're off and running. And they're easy closes, or 14-day closes, but their interest rate's a little bit higher. So
Right.
I got a 30-year fixed at 3.5%, which was kind of high because of a credit score was 620, but
Right.
3.5% on a 620 FICO score is amazing.
That's pretty good. That sounds good to me. Jeez,
I know.
come on.
I could have been below 3% if they had a 680. So
Yeah. Okay, let's switch over a little bit on the real estate side. What are you seeing in terms of supply and demand?
oh my God, it's on fire over here, and it's not literally on fire. It's just homes are hitting the market in Napa and surrounding area of Vallejo. I'm in Vallejo, but a lot of my
Right.
business is in Napa, and Napa is home hits the market. It's multiple offers over asking price. I think a lot of people are moving from the Bay Area, San Jose, and the city, and coming out here this way because they're probably selling their homes all cash and then paying all cash over here. So supply and demand, it's if you got a listing, it's going to sell.
Right. Now, I read today in an article that actually sellers are putting more houses on the market. Now, I don't know if that reflects what's going on up there. Is that true?
Not where I'm at. I mean,
Okay.
there's more buyers than there are sellers right now.
Tell
Which is
people where.
with everything going on, fires, COVID,
Right. Election. Come on, you got to throw that in. Hey, Darren, tell people where you work. What's your area, so that there's a context to what we're talking about.
My area is anywhere from San Jose to all the way up to Lake County, Clear Lake, Napa, Vallejo. I'm everywhere. They call me the zip code killer.
That's excellent. And do me a favor and tell people how they can get in touch with you as well.
Oh, my phone number is 408-425-7845.
Now, we are getting into, traditionally is the time of year where people are maybe not off market or trying to not sell, but there's other things normally involved, right? You've got holidays, you've got, the winding down, and it gets colder. This year is going to be different because really nobody's going to be doing a lot of that. Do you see the market slowing down at all?
6 months ago, you asked me that question right before COVID, and I was like,
Right.
yeah, it might slow down, and it never did. So I'm going to say
Right.
no, because we're just rolling along.
Yeah, I agree with that. And I also know for a fact, because the Fed chairman said so, we're going to have interest rates stay probably, where they are for the foreseeable future, in at least a couple of years.
Yeah, it's definitely a refi boom right now too. I just got a
Right.
client that submitted this morning that's going to redo their kitchen and all their bathrooms in their house, and then probably sell. So
Wow.
we'll see.
Yeah, we'll see. Darren, thanks very much for coming on and talking to us once again about what's going on in Central California. Really appreciate it. Thank you.
Thanks, Jeff.
Thank you. And that's Darren Woodworth. He's from Malibu Funding. Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening in, tuning in each and every week. We are on 8 major podcasts. They call them the Big 8, and you can look those up, figure out where they are. Just look for The Mortgage Voice, Jeff Barton, The Mortgage Voice. And we have archived on most of those podcasts, all of our shows, as we do on the radio stations, whether it's, the couple out in the Inland Empire, KMET and KCAA. KCAA we've been on for a long time. They have a great spread. They have a great reach, and really appreciate the efforts that they make in making us available to the Big 8 podcast, as well as a number of other avenues that you can hear the show. If you want to see the show, we do tape this. I guess tape is that shows how old I am. We record this show, and we have it on YouTube as well as KCAA and KMET. Both those outlets carry video feeds for, do they call it video still, Carol?
Or they just have a backup on their website. They show, video, I guess. Yeah, I call it video.
I guess, right. I mean, it isn't really video because there's no videotape. It is recording, so, it's whatever it is. I'm so old, I don't remember. I do remember.
A digital representation of oneself.
Yes. However, we politically correct say that, just to show my age. And people in our industry tend to be older. And what I mean by older is once you're in this industry, it's very tough to get out. I had a friend of mine the other day say, well, what the heck? There's a lot of stress. And by the way, in the industry right now, there is huge stress in the mortgage industry. I know that everybody wants things as quickly as possible. 30-day purchase is not easy to get. We did a loan for a client who bought a pretty good sized property, and Citibank was the lender. And Citibank told us that there's no way they can get it out before 40 days. Now, in the mortgage industry, 30 days is like, what we want to do because it keeps people coming back and excited. Realistically, as we are right now in the marketplace and how it's going, 30 days is rough. So if you're in a real estate contract and you're trying to negotiate and, you're in competition, as most people are, let's face it, real estate is really in demand. And if you're in any kind of place where real estate prices are somewhat in line with what people make in the area, that means you're going to have a lot of buyers. And that negotiating point, and you're trying to whittle down what you need as a buyer in order to get the property, right? And one of the main points is how quick can we close? When can we get paid? And that's 30 days, right? That's what everybody says. I can do it in 30 days. Well, realistically, in this market, 30 days is not happening. If you have lenders that can do it, it means you've got, 800 FICO score, you got 20% down, and your employment is solid 10 years, and you've got W-2s to prove it. That's the kind of borrower that you need to be in order to get this thing push through. But on that front, in terms of the business and how busy it is and what's happening and the exhaustion in the marketplace, talking about myself in general, it has been an exhausting time. And, we have doubled the business here at our company, the Malibu Funding, the one who sponsors the show, the one I work for on my day job when I'm trying to originate loans. But yeah, it's been busy, very busy. I talked to a company the other day, and that's a company, and there are many companies like this, that the owner of the company told all the sales staff and also the support staff that if they reach 100 million, they will get a trip to Hawaii, all of them. So I naively said 100 million a year. They go, no, that's 100 million a month. Okay, so that's a $1.2 billion company if you extrapolated out to 12 months. That's a lot of loans. I mean, if you're talking about average loan is $300,000, let's just say, times 100 loans, that's, what is that, 30 million? Yeah, so times how many loans you got to do to get to 100 million? So you're doing 350 loans in that month? That's a big company. Jeez, your staff is like exhausted. And if you're asking them to do more, you better be paying them a lot more. But even pay sometimes. And anybody who's out there who knows what I'm talking about, just nod your head. I can't see it, but I know you're doing it. And what I'm saying is, you know what? I have friends that are teachers, EMTs, emergency room workers. Now, these people are stressed. And they are making great money, but they would trade the money for less stress, less ability to have to go to work and dress up. I was in the emergency room the other day. I had to go in and my son had to get a COVID test. So we were there and everybody masked up, trying to do the best they can, and the protocols you got to keep and the stress you got to be under. Poof, unbelievable in those jobs too. So we're dealing in a marketplace filled with stress, the added stress of what's happening in the election, the added stress of not knowing if a virus vaccine is coming, affects people's decision-making processes when it comes to either purchasing a house or getting low interest rates. And the expectations on the professionals trying to do that job is really high. And I don't know how long the industry itself can match that. We've got two companies, and I mentioned this earlier in the show, United Wholesale and Quicken, which has now become Rocket, part of the Rocket family of mortgage companies. Both of them are going public. Both of them are looking to the public space for additional financing in order to do either their expansion, their advertising, or to fund loans. That is something, both those companies, by the way, are the largest mortgage lenders in the country. And they'll do 40% of the business we do for mortgage broker. As I said, it's a $3 trillion market this year. $3 trillion. Think about that for a second. This happens to be what we spent for mortgage, the stimulus package as well. $3 trillion. Oof. All right, let's get to some nuts and bolts of what's going on in the industry. The rates. Let's look at rates today, what the average rates are today, and they may have changed by the time you hear this show. But these ranges have been this way for at least 2.5 months. Ranges on the 30-year fix is 3.01%. The 15 years, 2.41. FHA is 2.37, and the jumbo is 3.38. Bonds. We talked a little about bonds earlier in the show. In earlier weeks, bonds themselves have been trading in a range from really the low 0.5 to half a point up to 6 points. And now it's trading outside that range, but it really doesn't mean that much. Why? Because the Fed is guaranteeing buying treasuries at $80 billion a month. So, this is the type of thing whereby the actual marketplace has no real say here because of the fact the Fed's just guaranteeing buying these. Yes, you can go, and yes, the yield got pushed up a little bit this week. What is it? The bonds are at 0.76, means the yield are 0.75 of a point rather than 0.6% of a point. So, yeah, it went up. I guess you're dealing in trillions of dollars, so a little bit makes you some money. Really, the bond market is going to remain where it is for the foreseeable future with the Fed buying what they're buying. And that means that mortgage interest rates are going to stay low, as Carl was saying earlier, up until 2023. So, yeah, that's what's happening. Anxiety that I talked about, that you may hear in my voice about housing, about employment, about the election, about COVID, all of this, plus the demand on the money. There's a lot of people out there who want to get loans, want to get refied, want to cash out refis. By the way, cash out refis are going to cost you more. The rates are going to be higher. It's just the nature of the business. If you have bad credit score, yeah, the rates are going to be higher. Any opportunity that a lender is going to have to be able to raise your rate from the lowest rock bottom, which I just mentioned, they're going to do because, let's face it, nobody knows who's going to be employed next month. Let's say that there's further evidence that COVID's going to last 5 years. Let's say that's on the table. What's that going to do to employment? What's that going to do to the government's ability to continue stimulus. I mean, we're all looking forward to May of next year when most of the people will have at least an opportunity to get out there and get a virus vaccine. If that doesn't happen, let's say it's September, October, November, what happens to government's ability to add stimulus or add debt? Really, that's what it is. And how does that debt affect U.S. monetary policy and the standing of bonds being bought and sold around the world? I mean, you can only sell so many of these things. Anyway, that's a lot of what the anxiety is out there. It certainly is with me. And most of the people that we talk about are so wrapped up with this election, they really are failing to see the significance of the long-term debt and the continued need to borrow if, in fact, coronavirus lasts and lasts and lasts. And we're not really dealing with it the way we should. Obviously, that's my opinion. But I think there's strong evidence that if we did deal with it, we could possibly open more businesses, especially when people are out of work and they need it. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.